Tom, in Bitcoin?
Yeah, crypto's been a huge disappointment because, whether it's debasement or geopolitical uncertainty or central banks easing, those are tailwinds for precious metals. It really should be a tailwind for crypto. But I think crypto had suffered and still hasn't recovered from that October 10th deleveraging. So you've seen the crypto market trying to recover. And in fact, early this year, there was probably some momentum until the whole Greenland surprise, and that caused another round of deleveraging. So I think crypto, in my opinion, is really watching this huge move in precious metals. There's a lot of FOMO for crypto traders, and I think they're actually buying metals. But in the past, these large moves in gold have actually been a precursor to a subsequent move in crypto. So I think part of this is we're seeing a big move in sort of non-US dollar assets, and that follows with crypto.
Why this comment matters more than it sounds. When Tom Lee talks about Bitcoin on CNBC, the market reaction is usually immediate but shallow. A few headlines circulate. Social media compresses a nuanced macro statement into a single bullish sentence. Then attention moves on. That cycle misses why these moments matter. Tom Lee is not a maximalist, a retail influencer, or a volatility trader. He approaches Bitcoin the same way he approaches equities, bonds, and commodities, as an asset responding to liquidity, policy constraints, and investor positioning. When he compares Bitcoin's trajectory to gold's historical behavior, he is not making a narrative claim. He is pointing to a structural pattern. Gold does not move because people suddenly decide it is valuable. Gold moves when trust in monetary policy weakens, when real yields compress, and when capital begins hedging systemic risk rather than chasing growth. Bitcoin's relevance, in this context, is not ideological. It is functional. The reason this comparison matters now is timing. Gold is not at an early cycle breakout. It is at record highs, being accumulated by central banks and long-duration capital. When an asset with no yield and no cash flow behaves that way, it tells you something about the system it exists inside. Tom Lee's argument is that Bitcoin is increasingly responding to the same pressures. This script is not about price targets. It is about understanding what conditions must already exist for this comparison to make sense at all. Gold's move to new highs is often explained lazily as inflation hedging or geopolitical fear, but those explanations collapse once you look at the broader market context. Inflation has already come down meaningfully from its peak. Equity markets are not in distress. They are hovering near all-time highs. Credit markets are functioning. Volatility is contained. If gold were simply reacting to panic or crisis, its price action would be sharp, erratic, and reactive. Instead, what we are seeing is a slow, methodical advance that continues even when risk assets remain bid. That combination matters. What gold is responding to is not a single macro headline, but a structural problem that policymakers cannot resolve cleanly: the long-term credibility of monetary coordination. Global debt levels are no longer a theoretical issue. They are a binding constraint. Governments cannot sustain elevated interest rates indefinitely without placing pressure on sovereign balance sheets, banking systems, and fiscal budgets. At the same time, cutting rates aggressively signals that currency stability is secondary to financial stability, which erodes confidence in fiat purchasing power. Central banks are effectively boxed in. Gold performs best in exactly this environment, where policy choices all carry costs and none restore trust outright. This is why gold's breakout looks different from past inflation spikes or crisis trades. It is not reacting to what policymakers are saying, but to what they are unable to do. Markets are beginning to price the reality that there is no clean exit from the current debt and rate structure, only trade-offs that shift risk rather than eliminate it. Gold thrives when the system moves from control to management, from precision to damage limitation. Another underappreciated dimension is who is doing the buying. Over the last several years, gold accumulation has shifted away from Western retail investors and towards sovereign institutions. Central banks, particularly those operating outside the US dollar's core influence, have been steadily increasing gold reserves. This is not momentum chasing, and it is not narrative-driven positioning. It is reserve management. These buyers are not trying to time tops or bottoms. They are reallocating away from assets that depend on policy credibility toward assets that sit outside it. Historically, when gold breaks out under these conditions, it is not signaling an imminent market crash. It is signaling a slow repricing of monetary trust. These regimes tend to unfold over years, not months. They are defined by persistence rather than drama, by allocation shifts rather than liquidation events. Gold does not spike and collapse in these phases. It grinds higher as confidence in the system erodes incrementally. This is the framework behind Tom Lee's comparison to Bitcoin. The point is not that Bitcoin and gold are identical assets. The point is that Bitcoin is increasingly being evaluated through the same macro lens. Not as a technology stock tied to growth cycles, not as a high-beta risk-on trade, but as a hedge against systemic constraints, policy limits, and the gradual weakening of monetary credibility. In that context, gold's breakout is not an isolated event. It is a signal. And Bitcoin's growing inclusion in that conversation suggests markets are beginning to think less about narratives and more about structure. For much of its history, Bitcoin behaved like a leveraged proxy for liquidity rather than a standalone macro asset. When central banks eased policy, real yields fell, and risk appetite expanded, Bitcoin surged harder than almost anything else. When liquidity tightened, rates rose, or financial conditions deteriorated, Bitcoin sold off more violently than equities. That pattern trained the market to categorize Bitcoin alongside speculative technology assets, even though its fundamentals never aligned with that classification. It was treated as high beta because it acted like high beta. That relationship is now weakening. Over the last several market cycles, Bitcoin's correlation profile has shifted in ways that are easy to miss if you are only looking at short-term price moves. Bitcoin still responds to liquidity conditions, but it no longer collapses automatically during every risk-off episode. Instead, it increasingly stabilizes or even outperforms during periods when the dominant market concern is not growth or earnings, but trust, policy credibility, and long-term purchasing power. That distinction matters. Assets tied to growth suffer when confidence in the system weakens. Assets tied to monetary neutrality do not. This does not mean Bitcoin has suddenly become low volatility or defensive in the traditional sense. It means the identity of the marginal buyer has changed. Early Bitcoin cycles were driven primarily by retail traders, venture capital flows, and speculative leverage. Those participants respond quickly to momentum and exit just as quickly when conditions reverse. Today, a growing share of Bitcoin demand comes from institutional allocators who approach it as a structural hedge rather than a trade. These buyers are not chasing upside catalysts. They are allocating against long-term risks that cannot be diversified away with equities or bonds. Institutional capital does not enter Bitcoin for the same reasons it enters technology stocks. It is not underwriting future cash flows, user growth, or product adoption curves. It is underwriting scarcity, neutrality, and portability. Bitcoin's fixed supply schedule, global liquidity, and independence from sovereign balance sheets place it in a fundamentally different category from growth assets, even if price action occasionally overlaps. Gold went through a similar transition decades ago. Before it was widely accepted as a neutral reserve asset, gold was volatile, politically constrained, and highly sensitive to policy shifts. It was periodically suppressed, periodically released, and often dismissed as archaic. Once it became embedded into institutional portfolios as a monetary hedge rather than a speculative commodity, its role changed. Volatility compressed, ownership stabilized, and long-term appreciation replaced episodic spikes. This is the parallel Tom Lee is pointing to. He is not arguing that Bitcoin has completed this transition, or that it now behaves exactly like gold. He is arguing that Bitcoin is entering the same phase gold once occupied, where it is no longer priced primarily as a growth proxy, but increasingly as a hedge against systemic constraints. In that phase, correlations shift first, narratives follow later, and price behavior looks confusing to anyone still using the old framework. The market's difficulty in categorizing Bitcoin today is not a sign of failure. It is a sign of transition. When an asset stops fitting neatly into existing buckets, it is usually because its role in the system is changing. Supply discipline and why it matters in this cycle. One of the least discussed, yet most important, elements of the gold-Bitcoin comparison is supply behavior. Markets spend an enormous amount of time debating demand narratives while largely ignoring the structural constraints on issuance. Over long time horizons, supply discipline matters more than short-term enthusiasm. Assets with elastic supply eventually absorb demand without repricing meaningfully. Assets with rigid supply do not. Gold's supply is relatively inelastic by nature. New discoveries are rare, extraction is capital-intensive, and bringing new production online takes years, often decades. Even when prices rise sharply, miners cannot flood the market with new supply in any meaningful time frame. That constraint is why gold responds so strongly to shifts in demand and confidence. The supply side cannot adjust quickly enough to dampen price signals. Bitcoin's supply structure is even more rigid. It is not merely inelastic. It is predetermined at the protocol level. There is no discovery process, no technological breakthrough, and no political intervention that can increase issuance. The total supply is fixed, and the path by which new units enter circulation is defined years in advance. Every 4 years, Bitcoin's issuance rate is cut in half. This schedule is not responsive to demand, economic conditions, or financial stress. It does not accelerate in booms or loosen in downturns. It is immune to lobbying, fiscal pressure, and policy objectives. In a global financial system where most monetary instruments are flexible to the point of abuse, this kind of rigidity is rare. Gold's long-term appreciation has historically had less to do with bursts of demand and more to do with the gradual erosion of fiat purchasing power. As currencies expand to accommodate debt, deficits, and economic shocks, gold's fixed supply becomes increasingly valuable by contrast. Bitcoin shares this same property, but expresses it in a faster and more transparent way. Supply changes are not inferred from mining data or production estimates. They are visible, predictable, and verifiable in real time. This transparency changes how markets interact with the asset. There is no ambiguity about future dilution. There is no debate about surprise issuance. Participants know exactly how much supply will exist today, next year, and a decade from now. That certainty alters risk assessment, especially for long-term allocators operating in an environment of monetary uncertainty. This is where Tom Lee's comparison becomes structural rather than rhetorical. His argument does not rely on enthusiasm for Bitcoin or belief in its technological narrative. It relies on capital logic. If global capital is gradually reallocating toward assets with credible supply discipline, assets that cannot be diluted to solve policy problems, then Bitcoin belongs in that category by design, not by storytelling. In cycles where monetary credibility is under strain, supply discipline stops being an abstract concept and becomes a pricing mechanism. Gold has played that role for centuries. Bitcoin is attempting to play it in digital form. Whether it succeeds fully remains to be seen, but the direction of evaluation has already shifted, and that shift is difficult to reverse once it begins. The role of real yields and policy constraints. Gold has historically performed best in environments where real yields are falling or outright negative. That condition does not always require central banks to cut nominal interest rates. It only requires that inflation-adjusted returns on cash and sovereign bonds become unattractive relative to assets that do not rely on yield at all. When holding money becomes a guaranteed way to lose purchasing power, the opportunity cost of owning non-yielding assets disappears. In those environments, gold stops competing with interest-bearing instruments and starts competing with trust itself. This dynamic is becoming increasingly visible today. Policymakers can maintain higher nominal rates, but if inflation, fiscal deficits, and debt servicing costs continue to erode real returns, the incentive structure changes. Cash becomes a temporary parking place rather than a store of value. Bonds become political instruments exposed not just to duration risk, but to policy risk, issuance risk, and credibility risk. Investors begin to look for assets that sit outside that framework, not because they are chasing upside, but because they are trying to limit long-term erosion. Bitcoin's behavior is beginning to align with this logic. It does not benefit from falling real yields in the same mechanical way as gold, but it responds to the same realization that holding cash guarantees a loss of purchasing power, and holding long-duration bonds embeds exposure to policy decisions that are increasingly constrained. As those realizations spread, assets that do not depend on yield and cannot be diluted or restructured to solve systemic problems gain appeal. This is not about rebellion against the financial system or rejection of institutions. It is about risk management within the system as it exists. Institutional allocators are not trying to overthrow fiat currencies. They are trying to hedge against the reality that policy tools are limited, trade-offs are unavoidable, and long-term outcomes are increasingly uncertain. Bitcoin's relevance in this context comes from what it does not do. It does not adjust supply. It does not respond to political pressure. It does not require confidence in future policy competence. This is the framework Tom Lee has consistently emphasized. Bitcoin's potential is not driven by utopian adoption narratives or expectations of universal usage. It is driven by portfolio construction logic. If an investor already holds gold as a hedge against monetary debasement, policy error, or systemic stress, the question becomes whether a digitally native asset with similar properties, but different risk characteristics, deserves a place alongside it. Because Bitcoin's supply is fixed, the implications of even modest allocation shifts are significant. If a small percentage of capital traditionally allocated to gold, cash equivalents, or defensive reserves is redirected toward Bitcoin, the price impact is nonlinear. This is not a speculative claim. It is a function of arithmetic. Limited supply interacting with large, slow-moving pools of capital produces outsized effects over time. That is the math underlying the comparison. Not enthusiasm, not belief, not narrative momentum, simply the interaction between real yields, policy constraints, and assets that exist outside the mechanisms used to manage them. ETF structure and why access changes everything. One of the reasons Bitcoin could not previously follow gold's path is access. Gold's role as a reserve asset was reinforced by decades of financial infrastructure, futures markets, ETFs, custody solutions, and regulatory clarity. Bitcoin lacked that until recently. The introduction of spot Bitcoin ETFs fundamentally changes who can hold Bitcoin and under what mandates. Pension funds, RIAs, and conservative allocators do not self-custody. They allocate through compliant vehicles. Gold's last major structural breakout coincided with the expansion of ETF access in the early 2000s. That is not a coincidence. Liquidity follows structure. Tom Lee's comments on CNBC come after this access barrier has been removed. That timing matters. Without structural access, the comparison would be theoretical. With it, the comparison becomes practical. Why this is not a short-term trade setup. A common mistake is interpreting this thesis as a near-term price call. That misunderstands the nature of gold-like assets. Gold does not move in straight lines. It grinds, consolidates, frustrates, and then reprices when positioning is wrong. Bitcoin is likely to behave similarly if it continues down this path. Tom Lee's framework suggests a multi-year process, not a single cycle blow-off. That process includes volatility, regulatory noise, and narrative fatigue. The key distinction is trajectory, not speed. The psychological shift most people miss. The hardest part of this transition is psychological. Investors trained to think of Bitcoin as speculative struggle to hold it through periods of boredom. Gold investors accept boredom as the price of protection. When Bitcoin stops delivering constant excitement, many will assume the thesis is broken. In reality, that may be when it is maturing. Tom Lee's comparison implicitly challenges expectations. If Bitcoin is becoming a macro hedge, it will not behave like a meme asset. It will behave like a reserve candidate. That is uncomfortable for both skeptics and maximalists. What would invalidate this thesis? This is not inevitable. Several conditions would undermine the gold comparison. If monetary policy regains credibility without currency debasement, gold's appeal would fade, and Bitcoin's alongside it. If Bitcoin's supply discipline were compromised, the analogy would break entirely. If regulatory frameworks made institutional holding impractical, capital would not rotate. Tom Lee's argument assumes none of those conditions materialize at scale. That assumption is reasonable but not guaranteed. Understanding that risk is part of responsible positioning. Why this matters even if you don't hold Bitcoin. Even for investors who never buy Bitcoin, This comparison matters because it reveals stress in the global monetary system. When both gold and Bitcoin attract long-term capital simultaneously, it signals declining confidence in policy tools. That signal precedes changes in capital allocation, geopolitical alignment, and regulatory architecture. Ignoring it because of ideological discomfort is a mistake. What Tom Lee is really saying. Tom Lee is not predicting a price. He is identifying a regime. Gold's breakout is not about fear. It is about trust erosion. Bitcoin's alignment with that breakout suggests it is being reevaluated as a monetary asset rather than a speculative one. That transition, if it continues, will not be obvious in headlines. It will show up slowly in portfolios, policy discussions, and capital flows. By the time consensus agrees, the repricing will already be advanced. That is the lesson history teaches, whether the asset is gold, bonds, or something entirely new. And that is why this comment, delivered casually on live television, matters far more than it initially appears.